Welcome to Stock Mo. You could be sitting on the biggest missed opportunity of the next decade right now and not even know it. Not because you're not paying attention, not because you're not smart, but because the financial media keeps pointing you toward the same overcrowded trades, the same hyped-up names, the same companies that already have massive valuations baked in. Meanwhile, a handful of stocks, real businesses with real earnings, real cash flow, and explosive long-term growth ahead are sitting quietly, barely getting any attention at all. That changes today because right now in this video, I'm going to walk you through 7 stocks that I genuinely believe are positioned to deliver serious returns over the next several years. These are not lottery tickets. These are not meme stocks. These are fundamentally strong businesses that the market has either ignored, misunderstood, or temporarily punished for the wrong reasons. And that's exactly where the opportunity lives. If you're the kind of investor who thinks about building real wealth over time, not chasing quick flips, not gambling on hype, then you're in the right place. Hit that subscribe button right now and turn on notifications because at StockMo, this is exactly what we do every single week. We cut through the noise. We look at the actual numbers and we find the companies that are worth owning for the long haul. Now, before I get into the names, I want to set the context for why this particular moment in the market is so interesting. Right now, there's a portion of the market that has gone completely vertical. Valuations that are hard to justify, sentiment that has gotten ahead of the actual business fundamentals. And I'm not saying those companies are going to zero. Some of them might do fine, but the math of buying things at the absolute top of a hype cycle rarely works out the way investors hope. History has shown that repeatedly. What does work and what has always worked decade after decade is identifying companies that are genuinely growing, that have operating leverage starting to kick in, that generate real free cash flow, and where the market, for one reason or another, hasn't fully priced in what the business is becoming. That's the kind of investing that compounds wealth quietly and then seemingly overnight produces results that look obvious in hindsight. That's exactly what I'm looking for. And those are the 7 companies I'm going to share with you right now. The first 2 I want to talk about together because they operate in the same industry and honestly make sense as a pair. Those 2 companies are Uber and Lyft. Now, I know what some of you are thinking. Uber, that's not exactly a secret. It's a huge company. And, yes, you're right, Uber is a roughly $150 billion company by market cap. So, it's not some tiny unknown name. But here's what's interesting. Despite being one of the most used apps on the planet with a trailing price-to-earnings ratio sitting around 18 and a forward multiple of about 22, this company is priced like a mature slow-growth business. And it is absolutely not that. Over the past 5 years, Uber has grown at roughly a 25% annualized rate. Revenue is still compounding in the high teens. Operating profit has hit $6.3 billion on a trailing 12-month basis. Monthly active users are approaching 200 million. The number of trips being taken continues to rise. And critically, both the mobility and delivery segments are growing gross bookings at close to 20% year over year. This is not a company that has peaked. This is a company that is still in the middle of its growth story. Now, the big concern everyone raises about Uber is autonomous vehicles. Waymo is on the roads. Tesla is talking about robo-taxis. People are worried Uber is going to get disrupted and replaced. And I think that analysis, while understandable, misses something fundamental about how Uber has actually positioned itself. Uber is not trying to build its own autonomous vehicles. It's not racing to manufacture hardware or develop its own self-driving stack. Instead, it's building a platform, a marketplace of supply and demand, and inviting every autonomous vehicle company to plug into that marketplace as a supplier. Think about what that means. Waymo, Tesla, and a dozen others are competing fiercely against each other to win the autonomous vehicle race. Uber sits above all of that and says, "Great, plug into our network and access our hundreds of millions of customers." The technology layer, the hardware layer, all of that becomes a commodity. What doesn't become a commodity is the customer relationship, the trust, the habit of opening that one app, and Uber owns that. That's a remarkable position to be in. And at 22 times forward earnings for a business growing this quickly, the valuation does not reflect that vision at all. If the autonomous future plays out even partially in the way many expect, Uber could be one of the best performing large cap stocks of the decade. Now, Lyft is a smaller version of this same story. About 1/10 the size of Uber by active riders, growing bookings at around 16% annually. Not quite as dominant, not quite as diversified. But here's the thing, Lyft's forward price to earnings is sitting at about 9.6. Its forward price to free cash flow is around 5 times free cash flow for a company growing double digits in a duopoly market. The market is pricing Lyft like it's going to disappear. I think that's completely wrong. Owning both together is like a basket play on the future of transportation, and you're getting Lyft at a price that implies almost no good outcome. The upside from that kind of setup can be extraordinary if you're a patient. Drop a comment below and let me know, are you already holding either of these, or are they new to your watch list? I love hearing how you're thinking about these names. The third company on my list is one that a lot of investors have been sleeping on. And honestly, I think that's partly because it's a shoe company. When people hear athletic footwear, they think of Nike struggling, Under Armour contracting, Lululemon missing targets. There's a mental model that the consumer is stretched and the apparel and footwear space is tough. That mental model is costing investors money because it completely misses what On Holding is doing. On Holding just guided for at least 23% growth in 2026. They raised their gross margin guidance. They raised their profitability guidance. And the stock went down after earnings. That is the definition of a misunderstood company. And that kind of disconnect between what a business is actually doing and how the market is reacting to it is exactly where long-term opportunities are born. Here's what makes On Holding different. This is not a budget brand. They're not competing for the customer who's looking for an $80 shoe. Their core customer is spending over $200 on footwear. That demographic, higher income households, people who aren't dramatically changing their spending habits because of macroeconomic pressures, is remarkably resilient. And within that demographic, On Holding has done something that most athletic brands have consistently failed to do. They've made their products aspirational to women. The majority of high-income household spending decisions, particularly in the US, are made by or heavily influenced by women. On Holding markets intelligently to that audience. Their product design, their brand identity, the way they show up in the market, it resonates with the demographic that actually drives premium consumer spending. That's not an accident. That's a deliberate strategy that is compounding. Their shoe segment has been growing at about 26% annually since the end of 2023. But here's the part that most people miss entirely. Their apparel business is growing at 56% annually. Their accessories business is growing at over 80%. These are still small pieces of the overall revenue, but they are growing from a small base into what could become very significant businesses. When you have a brand that people trust and love, expanding that brand into adjacent categories is one of the most proven ways to extend a growth story for years. At 22 times forward earnings for a company delivering 23% growth with expanding margins and a runway of product categories still largely underpenetrated, On Holding is, in my view, one of the most straightforward compounders available to investors right now. Number 4 on my list is Alphabet. And I want to be upfront that this one has run quite significantly over the past several months. It's become a very large position for many investors who've been holding it for a while. But even after that run, trading at around 30 times forward earnings, Alphabet remains one of the most compelling businesses on the planet. Search is growing at roughly 16% and actually accelerating, not decelerating, which was the fear when AI chatbots started gaining consumer traction. That fear has not materialized in the actual numbers. People said AI assistants were going to eat Google's lunch. And what actually happened is that Google integrated AI aggressively into search and maintained its dominance. YouTube is growing at 22% annually and continues to be, in my opinion, the single most underappreciated streaming and content platform in existence. Google Cloud is growing at a 40% compounded annual rate. The AI infrastructure business alone could eventually rival the entire current value of the company. What I find most compelling about Alphabet as it relates to AI is the diversification of exposure. If you believe AI is transformational, but you're not sure which company wins the model race, the chip race, or the application race, Alphabet gives you a stake in all of it. They're building their own chips, developing frontier AI models, and they have one of the largest distribution platforms in history for deploying those models. And underneath all of it is a cash flow machine generating tens of billions annually. If the AI spending cycle ever resets, Alphabet can throttle capital expenditure, get more profitable, and acquire assets that become cheap. Exactly what disciplined tech companies did after the dot-com era. If you found this breakdown useful so far, please take 2 seconds and hit the like button. It genuinely helps this content reach more investors who are trying to think carefully about their portfolios, and it helps Stock Radar keep producing this kind of analysis for you every week. The fifth name is one that has a very different profile from anything else on this list, and that's Hims & Hers Health. This is a small company, market cap around 5.7 billion, and it's operating in a space that carries more volatility and uncertainty than most of what I talk about. But that volatility and uncertainty is also exactly what creates the asymmetric upside. The concept is straightforward. The traditional healthcare path in America, find a primary care doctor, get a referral, see a specialist, submit to insurance, wait for approval, pick up a prescription, is broken. It's expensive, it's slow, and it fails enormous numbers of people who have treatable conditions and are perfectly willing to pay out of pocket if the experience is better and faster. Hims & Hers built a direct-to-consumer telehealth model that shortcuts all of that. You describe your issue. You get connected with a licensed clinician. You get a prescription if appropriate. It's delivered to your door. The whole experience is cleaner, faster, and in many cases cheaper than going through traditional channels. They started in a couple of specific categories, men's sexual health and hair loss, and expanded from there. The GLP-1 weight loss medication space became a massive catalyst. And looking forward, the company has talked publicly about peptides and longevity treatments as the next major category. Every new category they enter is another layer of potential growth on top of a business that has already compounded revenue at 54% annually over 5 years. They're generating positive free cash flow. They've been making acquisitions, most recently a high-growth telehealth company in Australia called Eucalyptus, which extends their geographic footprint. Management has put a target of $6.5 billion in revenue by 2030 on the table. If they come anywhere close to that, buying the stock today at a $5.7 billion market cap looks in retrospect like an obvious decision. I'll be the first to say this one is not for the faint of heart. The stock has been wildly volatile. There will be regulatory questions. There will be competitive pressures. This is a company where things will not go in a straight line. But investing in early-stage disruptors in large markets never does go in a straight line. And the payoff for holding through that volatility when the fundamentals are genuinely strong can be extraordinary. Company number 6 is one that I think has been massively misread by the market, and that's Duolingo. At its peak, this stock was trading above $500 a share. Right now, it's sitting around $110. That kind of decline triggers a lot of negative sentiment, a lot of headlines, a lot of people writing off the company, and I think that's creating one of the better buying opportunities in the software space right now. Here's what actually happened. Duolingo ran a very high-profile marketing campaign, the Dead Duo campaign, that drove a significant spike in user growth and engagement in early 2025. That spike created a very tough comparison for the most recent quarter. So, the year-over-year growth numbers look softer than they really are on a normalized basis, but the underlying trajectory of the business remains intact. Revenue has compounded at 38% annually since the end of 2023. Management is targeting $700 million in adjusted operating cash flow. The most recent quarter added nearly 4 million daily active users, and momentum on that front is clearly building again. But more importantly than any of those numbers, there's a strategic evolution happening at Duolingo that I think most investors are missing. When most people think of Duolingo, they think of learning Spanish or French on their phone. That's still there and it's still growing. But Duolingo is becoming something much larger than a language learning app. They're building a full educational platform. Math is already live. Science and history are expanding. The pace of adding new courses has accelerated dramatically in the last 2 years, largely because AI has made course development cheaper and faster. Think about the addressable market when you stop being a language app and start being a platform for lifelong learning. Every skill you want to develop, every subject you want to understand better, potentially delivered through that same gamified behavioral psychology-driven experience. And that has made Duolingo one of the most engaging apps ever built. The subscription becomes more valuable with every category added. The reason to stay subscribed becomes stronger. Churn goes down. Revenue per user goes up. At a forward price to free cash flow of around 16, you are paying a very modest price for that vision. When growth reaccelerates, and I think it will, the sentiment shift could be rapid and the stock price reaction could be substantial. I'd rather own it at $110 and be early than try to chase it at $300 after the narrative has already changed. Share this video with someone in your circle who's been looking for fresh investment ideas outside the mainstream. These are the kinds of conversations that rarely happen on mainstream financial TV. And a lot of people in the 45 to 55 age range are right at the point in their financial lives where finding the right compounders can genuinely change what the next 2 decades look like. Pass it along. So there you have it. 7 companies growing fast, building real cash flow, and trading well below what their futures are worth. Uber and Lyft for the transportation revolution. On holding for premium consumer momentum, Alphabet for AI exposure without the guesswork. HIMS and Hers for healthcare disruption. Duolingo for the future of education. Zeta Global for applied AI and enterprise marketing. Drop the name of whichever one you want me to go deeper on in the comments. Subscribe to Stockra if you haven't already. Hit the bell and I'll see you in the next.